Thank you for joining us on Minds of Commercial Real Estate. Today we have Tony Valte from Tax Mitigation Group. Tony, thank you for being on the show.
Thank you. Do appreciate the time.
You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
So Tony, give us a little bit of background about yourself.
Again, name's Tony Valte. I'm a tax strategist. I have my Master of Laws in taxation from the Boston University School of Law. And after graduating there, I went straight into tax consulting. So it's a hybrid between practicing law and CPA work, but I do my best to make sure clients pay the least amount of tax possible within the law.
All right. Amazing. So let's go a little bit more into detail about how these work, what's possible, how they're approved with the IRS, and give us a sample and a background on one maybe.
Perfect. So although I can offset, ordinary income, capital gain income, I'll keep it capital gains.
Sure, we'll
for
start
right
with
now,
that.
especially because, you're in the commercial real estate industry or the real estate industry. And I do work with a lot of brokers as well that have capital gain issues. So take, for example, here in California, capital gains tax is very high as opposed to some states. We're actually the highest in the nation. You have a 20% federal tax and then a 13.3% state tax. So a client who's selling a commercial building or any property, or if they're selling a business, for example, the one thing they tend to forget is that 33.3% tax on the gain, that is, not the total purchase price, because they might have basis in there. But if you end up paying 33%, let's say you have a $10 million gain, which is fairly normal, especially in your industry. It might actually be lower than that. They're going to end up paying $3,300,000, absent whatever the basis would be, but we're making the math simple. And some clients, they get shell-shocked, and they own the building for a while, or if it's a business that they've owned for a long time and it's a legacy of theirs, the last thing they want to do is pay out 33.3% to the IRS and the state of California. So they come to me, and then I put them in a specific tax strategy that I have within my firm. It's guided according to an IRS Treasury regulation, but I can legally cut their tax rate in half, down to 16%.
Okay.
So instead of paying $3.3 million, you just kind of divide that by 2, and that's about 1.6, something like that. But then they end up net saving, say, 1.6 million, and for all practical purposes, that's money lost. It's gone. You're paying IRS, you're paying the state. Now they have these net savings, and I don't care what the deal is. If you're chopping your tax rate in half and those net savings, that's going to be a huge benefit, and the time value of money. It's not money lost now.
Right.
Now you're having money that you would not have had, and you can invest it. And people in your industry, they're always on to the next.
Absolutely.
What's next? We don't retire in this world.
No,
I don't
it keeps
know about
going.
We keep going. So I help preserve the proceeds.
That's if somebody does not want to do a 1031 exchange.
Correct. Now, we do have 1031 exchange programs. Everything's about liquidity. Normally, in a 1031 type of transaction, all you're doing is relinquishing a property and you're replacing it with a replacement property. That's it. No capital gains tax, because you're just doing that like kind. A lot of pitfalls and timelines.
Okay.
45 days, 180 days. And, everyone can do research on that. But we have a specific program to where once the client receives the replacement property, we put them into a separate transaction where they can, similar to, like, say, refinancing, where they can cash out from that replacement property at around 93 cents on the dollar on the gain, whatever the taxable gain is. That way they didn't pay the capital gains tax and they were still able to get liquid. But it's a specific detailed process, because if you do it wrong,
Got it.
Welcome to the IRS and the Franchise Tax Board party.
Sure.
And, we definitely don't want that. The last thing I ever want to do is be a part of an audit, but that's why I'm very conservative in the tax mitigation, which is, for the most part, it's aggressive. Definitely aggressive.
So this one that you were just speaking about is after a person does a 1031, then they do your strategy, after the close of the 1031.
Yes, well, we can get ahead of it. Let's say, for example, the firms that I work with in my network, we have undeveloped land too, or land readily available if a replacement property
Okay.
isn't there. So, and that's usually the tough part. So if we can make the like kind qualify, what happens is now if they don't have a property in place and they want to do it now, we have property that's available for them to look at. And then obviously the lending network as well that is very familiar with the land and get them their money, their loan. And as we all know, loans, those aren't taxable.
Correct.
So that's the benefit of doing it. So now they're liquid. And then, as we said in this industry, no one ever stops.
Okay.
They go on to the next thing.
Now, can they combine and do a cost, can they do a 1031 exchange for like a portion of it and do the other strategy you were speaking about for another portion of it? Or is it one or the other?
No, in that particular thing with a 1031, you'd have to go relinquished property to replacement property. There are stretches to where maybe you can go from a single unit to a multi-family unit, maybe. That would be a state to state too. A specific thing, nothing really federally, but generally you either choose one or the other. You either sell off and liquidate and pay the least amount of tax, or you go the 1031 route properly, do the like kind exchange, and then we can help you cash out, get liquid.
Got it. Let's go through one particular sample for a client that does not do the 1031 exchange. And we'll do easy numbers, right? Basis is 10 million. Sale price is 20 million. Capital gains is 10 million.
Okay.
So how would we go at any
Yeah,
particular
so
loss?
whenever I speak to a client, I first start off with kind of what you just said. What's your financials? What's going on? Obviously, I need to know the state because I need to know the tax rate that I'm dealing with. But we're in California, so we're going to do the high taxes. So if they have a $20 million sale, $10 basis, their gains $10 million, their tax is going to be $3,300,000.
Sure.
$2 million of that goes to the IRS, and then 1.3 million of that would go to, for example, the Franchise Tax Board.
Right.
That's a lot. Fortunately, guys like me are around to be able to counsel clients. So when I meet with a client, I take them through where they're at now, where I can take them, and where I take them, the destination is 16%. And that's a massive savings no matter what. But when you're $10 million gain and you're about to pay 3.3, paying 1.65 is not that bad, knowing you're going to get that money back. Now you can plan ahead in terms of what you're going to be doing with the extra, the extra savings. Then we have to go into, well, how do we get the journey?
Sure. Exactly.
To get from where you're at now to where you need to be. And that's my partnership special allocation.
Now, do they hire you before the transaction is started, during the transaction, after the transaction is done? Where do you usually like to get involved?
This is the best part. It's not like there are other strategies out there. Like some may in the real estate world, it's commonly known as the deferred sales trust. Or in the legal world or the tax planning world where I'm at, we call it an intermediary trust. When you're doing those type of strategies, you need to get ahead of the sale. You want to get ahead before the LOI, for example, or any type of offer to purchase is already in place because you have to have the trust set up. With my partnership special allocation, you could tell me that things are closing tomorrow.
Okay.
And the next day, I always come in once it's closed. Funds have settled. Because I tell clients, even though you can technically wait to the end of the year to do it, because you're only going to be reporting taxes that following April, you don't want to wait until the end of the year. Number one, I only have so much allocation allocated to me every year. Like this year in 2025, the partners that I work with, I have a 5 billion target loss allocation. So it sounds like a lot, which it is. But when I'm doing 10 million here, 15 million here, 30 million here, 100 million, my allocation runs out. So there's no saying at the end of the year if I'll have your allocation for you. So you got to secure it now. Also, it's supply and demand. The less my allocation starts to go down, rates could possibly go up a little bit, but for the all intensive purposes, if I did talk to a client, say now, and they waited till the end of the year, and I had the allocation available, I always want to make sure that my rate is what I at least verbally told them, even though I could raise the rates. The more pressing issue is the allocation itself. And then the third issue is, what if they end up spending all the money or investing it? And then when it comes time to, for example, generate that $10 million loss for them that offsets the gain, my cost is 1.65 million, or say 16%.
Sure.
They might not have that cost readily available for me to generate that loss. So it's always advisable, once escrow closes or the transaction closes and funds settled, that's when I meet, and then we do the transaction. They prepay pretty much their lower rate. I get them their Schedule K1 loss, and they're happy, and their CPA is happy. But now they insured, okay, in your example, I'm that client. I'm like, all right, well, I tax planned properly. I tax planned early. I know that 1.65 million is all mine. It's actually 1.7 because I charge a 16% rate on 33.3. So they would end up netting around 1.7 million. It would just cost them 1.6 million to fund into my strategy to generate that loss. And
Sure. That was actually going to be my next question. What is this cost for an individual to do this?
to reverse engineer and back into it, whatever the target loss allocation is, and in our example, the target loss allocation would be the gain, 10 million.
Sure.
So your client or you or the CPA would come to me and say, all right, we just did this real estate deal. My client has a $10 million gain here in California. Then I know automatically that 16% of that target loss is the contribution of the funding, the skin in the game.
Right.
The client has to
1.67
put
million.
1.6.
Right.
Yeah,
Got
so
it.
it would cost them 1.6 million that I use to fund the strategy. And then when the strategy is in place, and that only takes maybe a week or two
Okay.
for me to get done, because you have to have the proper sell series partnerships and agreements, because it's an actual business that the client gets into. But we use that to fund the strategy, and then the loss is generated in the year that the partnership is done, and we allocate the 10 million loss to the client. Now I just need to know, is it individually owned? That's one of the things we need to know.
Sure.
A lot of times, especially that upper echelon you and I were talking about, that type of client, it's never in their name. It's in an LLC, or it's going to be in a limited partnership or a family limited partnership or a trust or anything like that. And those are informations I need to know outside of what the gain I need is.
Okay.
What's the entity structure, so I know who to issue the Schedule K1.
What is your fee?
My fee is actually, this is the best part. I'm not your typical firm, like CPA firm or a law firm where I charge hourly or I charge a huge retainer. Any fees that go to me, any fees that go to my network of partners that I work with to generate that loss, it's all padded into that 16%.
Okay.
And that's a one-time fee. So let's say, for example, I put a client into a partnership special allocation strategy this year. The lifetime of the partnership, 16 years, but there's no other cash outlays in year 2, in year 3, in year 4, in year 5, so on. So it's a one-time funding amount, and any fees that go out to partners or whoever referred me as well, everything is within That's 16%.
Now, is this only for sale of properties, or can this strategy be used for sale of a business as well?
Oh, no, both. Anytime there's a capital gain. I do it for business sales. I do it for real estate sales. I use the strategy as well for ordinary income, preferably non-W-2. No, W-2 income's hard
Okay.
to reduce, but my typical client here in California, say they make $1 million. They're like, Tony, man, it's $500,000. It seems like it's going to the IRS in the state. They come to me. I put them into the partnership special allocation, but I go at 20% of the target loss. So it costs them $200,000, for example, for me to generate that Schedule K1 loss, to take that $1 million and wipe it out, but it cost them $200,000. So typical client that paid $500,000 usually ends up netting $300,000. So that's why I like the strategy for several reasons. One, the flexibility. I can attack all types of income. W-2 is the hardest because there's restrictions the IRS has. So, that's good there, but it's flexible there. But also, it's important for viewers to know too, when you talk to tax mitigation specialists like me, some do rental strategies. Let's say tiny homes or anything rental where you're utilizing the Section 179 or 168 depreciation deductions. Those are great, but the client has to materially participate to get that typical passive loss to an ordinary loss. And that can be burdensome because it's minimum's 100 hours a year. You got to prove to the IRS that you were working on a strategy to get that loss. My partnership special allocation, the client doesn't need to do nothing but fund it just by operation of law. It's not a passive activity. So it's an ordinary loss, which makes it easier for me. Because then once the transaction's done, they're funded, and I get them their loss, there's nothing much the client needs to do, because after that, throughout the lifetime of the partnership, I'm there to make sure they're getting their reportings, so on and so forth. They don't need to really worry about much up until the end of the partnership, where I work with them. Do they want to dissolve it? We make sure the line of credit's paid off, because remember, it's a big line of credit.
Sure.
So during the lifetime of the partnership, when we're doing the business, we don't pay out distributions at all. It's a retail operation, buying and selling currency forward contracts or Forex, but not investing into it. It's almost like a broker-dealer, buying low, selling high. So we don't pay out distributions. Little profit adds up through the 15 years. But we do that because we don't want to have any negative capital accounts.
And
Then
this is for 16 years. So you're talking about the
16
end of the
years, yeah. So during that first 15 years, no distributions are paid because we don't want to have a negative capital account, which triggers a deficit restoration obligation. Now, my trading partners and the client have to make that negative capital account positive, and we don't want that to happen. So we let the partnership build up so that when the 16th year comes, this is where the magic is. But to get back to that, we need to have the deficit restoration obligation because the client's taking a leverage deduction. They get audited. IRS looks at two things. Is it a real business? It's not a listed transaction or a sham or a scam. And this is a legitimate business. The LLCs are proper. They're really partnerships. It's generating profits. It's generating losses. Then the IRS is like, okay, well, client A took a 5-to-1 deduction. They only put in a couple $100,000 on ordinary income, for example. They only put a couple $100,000 in, but they took $1 million loss. Do they have risk here on that spread? And the answer is yes. Now, we mitigate that risk, obviously, because what happens is by the time the partnership ends in the 16th year, there's going to be more than enough in there to pay off the revolving line of credit. And this is alternative financing. So viewers know this isn't anything that would show up on, like, say, your client or any referral clients, for example, credit report. It's stuck at the Cell Series LLC level, not personal, and it doesn't affect their credit profile, which is huge, especially for people in the commercial real estate industry, because they rely on that to get more property. So it's important for them to know that this doesn't affect their credit profile. But in year 16, a decision needs to be made on the partnership. One is pay off the revolving line of credit, zero out the accounts. Now, whatever gain is in there is going to be allocated to the client now.
Okay.
Yes, it's going to reverse. We call it the reversal year. It's going to now go to the client. The good thing is it's a taxable event, but I'm there. So we can kind of, that's what I meant by a good thing. I'm there to relieve that taxable burden. But even if they have a tax, the main goal obviously was 16 years before, when they were able to have that net savings and that time value of money. What that 1.6 million in savings,
Over 16 years.
do the math, man. Even if they pay a tax at the end of the year, 1.67 million, you just put it at, even T-bonds or something, whatever it is. Who cares,
Sure, makes sense.
They end up becoming net positive at the end of the day. So we can do that, close up the partnership, call it a day, make sure they pay less tax. Most of my clients do something different. They extend the partnership.
Another 16 years?
Pretty much. It's really perpetually until they die. Then they transfer the partnership interest to their heirs.
Okay.
Now the heirs get the partnership interest with a stepped up in basis. No tax.
Got it.
The rich buy, borrow, and die.
So every generation step up in tax.
Yes, so it's like property. If you transfer real estate to your children upon your passing, whatever the fair market value is at the time of that transfer, that's their new basis in the property. So if they sell it, the capital gains tax could be zero or could be less, but going to be a lot less than what the original legacy who got the property was their basis at.
Okay.
This is the same thing. So all of our clients that I do deal with, they fortunately could care less about whatever's in that partnership, and they'd be happy to give it to their heirs. So they would just continuously extend the partnership, no matter what, because even after 16 years, 17 years, 20 years, that number is going to grow in terms of what's in the partnership, and at least the heirs will get it tax-free or really mitigated, if not tax-free.
To new what is it? Floor.
A new floor, yes. And then that's the way that the people that are fortunate to be in that position, they buy, borrow, and die. And that's what all the Bezoses of the world, the Musks of the world, the Buffetts of the world, that's why they pay, 0.01% tax usually?
Right.
They're borrowing. They're borrowing against all of their assets. And their assets are growing way more than whatever the interest is on
The borrow.
on that borrow. So they're always net positive, and they keep borrowing and borrowing. And last time I checked, they're the only ones that keep growing and growing and growing at a rapid pace.
Very interesting tax strategies. And,
Yes.
if there's one thing you would like the viewers to know with everything said, and probably you have other tax strategies, for the average Joe that's making the million, either be W-2 or the K-1s, what would it be?
It doesn't hurt to know that there's other options out there. Get the information. Listen to it. See the strategy. Let me show you where you're at, where you could be, and how I get you there. And if you do it, you do it. And if you decide not to do it, it's not everyone's cup of tea, then you don't do it. But at least you had that value of information, and you knew it was out there. And I could say I told you so if you don't work with me, but normally clients are just happy with the value. That's why I work with a lot of strategic partners. My goal at the end of the day is to help brokers, CPAs. I'm an added value to their practice, that value of information, kind of like what we're doing.
Sure.
Right now, educating, informing, that value in advance, what I call it. They know that they're at least going to get that information. And brokers use me sometimes. I could be the difference between getting a listing or getting a deal or not. You have two competing brokers, both excellent. but one also offers, hey, not only am I going to maximize the sale on your property or get you the most amount of money that you can get, I also have a team underneath me that's going to show you how to preserve that money, pay the least amount of taxes, and that could be the difference between, getting that listing
Go
or
for
not.
somebody else.
Yeah.
Well, thank you, Tony, for all the valuable information. Thank you for being on the show. How can viewers get a hold of you?
You can actually get a hold of me at Tony Valte, JD, LLM, at taxmitgroup.com. But that's it's all three letters. So it's TAXMITGRP.com. You can also call my cell. I'm real personal. Yeah, I'm not a text guy or anything usually. Phone call is always the best, but local cell phone number, the direct ones, 310-849-2211.
Great.
And those are the best ways to get to me, and, I can answer your questions from there.
Thank you very much, Tony. Appreciate it.
Perfect. Thank you.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. Let's get together.